Hey, welcome, welcome, welcome. Thank you for taking the time to join me today on this home buying financial workshop. My name is A.L.I, and I'll be your host today. First, what we're going to be doing is talking about just a brief introduction of myself, what this is for. Then we'll be jumping into the five topics that we do have, which is simply finances and budget for topic one, understanding credit for topic two, cost of home ownership for three, mortgage financing 101 for four, and the roles in having a team in place as you go through this mortgage process. Thank you again in advance for taking the time to go through this quick workshop here with me. I believe that the goal of this is going to be extremely impactful for you guys and helping you guys accomplish something new and also increasing your current financial awareness and confidence so that way you guys can have enough tidbits of information so that way you guys can actually have the confidence to conquer your goals and get there a lot quicker and empowering you guys to make decisions for yourselves and obviously having your money work for you and not against you. My name again is A.L.I. I've been in the mortgage industry since 2001 as a mortgage professional and also as a financial advisor. So finances is my thing, and I'm trying to make sure that we all can grow as best as we can so that way we can build and grow generational wealth so that way we can help our families out long term. I'm currently with Barrett Financial Group, which is a national mortgage broker. We have over 50 different lenders that's out there, which means each lender has multiple programs available, giving us hundreds of options to choose from based on your particular need, customized situation, and your goals that you do need. Partnering up with my company, Ascending Legacy Investments, is putting you guys in the best spot so that way we can help you guys get into this mortgage process and take away the stress and make it more simpler for you to understand and more enjoyable to go to, as much as enjoyable of a mortgage process can be. All right, so why is this workshop important to me? Why is it important to build financial awareness and improvement? Uh, More or less, as you can see right here, in just two words, wealth disparity. Biggest thing about this about 1973-ish is when the rich and the poor divide started to get further and further and further apart, meaning that we stay level, the 90% stay level for the most part. The top 10% continue to go up and go up and go up. Now, not a bad thing by no means. However, the 90% is struggling in regards to September 22. National Energy Assistance Directors Association says that 1 in 6 American households can't keep up with their energy bills. This is over 20 million Americans that can't pay their energy bills, just the light, the gas, uh, so that way they can have just comfortability in their own home. Yet while the top 10% are the ones that do want to take advantage of it that can, they go to Bugatti and get one of their special made cars that they do have, only making 99 of this new one, the W16 Maestro that you can see. It's a beautiful car. Don't get me wrong now. But it goes for 5.27 million. They're only making 99 and they have already pre-sold all of them. They're not going to be out for another year and a half. However, they're already sold out when you got 1 in 6 American households not able to keep up with their energy bills. This is wealth disparity at its finest. This is, I don't know how else to explain it, but this is the reason why I want to put this kind of workshop out there so that way we can bridge this gap, increase our own personal financial awareness, so that way once we get to the point of reaching our goals, we can make that decision of what we want to do with that money. If we want to go spend 5 million on a car, if we want to pay our energy bills, we can comfortably without being stressed out. And that's the most important thing of why having financial security, independence, and being able to create wealth is more important than just spending it and keeping up with the Joneses in regards to clothing, material things. We want things that matter. So as you guys can see in this particular slide, it's a little bit of a comic relief and a little bit of hitching in the face of exactly what's really going on. So as you guys can see, there are comics being done showing the disparity that's already there. This is not a secret. This is a known fact. And as you can see, the one right below me here is probably one of the funniest ones is you got a CEO walking past and you got a guy that's being robbed here on the street and they're calling him an amateur. I don't know what that means to y'all, but it means a lot of different things to me in regards to that. But if you look at all of these here, you can easily see that the income inequality, the wealth disparity is getting serious, and more serious, even though they're making light of it with some of these comics here on that I do have here posted. However, one of the most important things that I want you guys to see is the one directly uh, that way to where you can see $300 billion of consumer debt for the 90% has increased in just a 1 year time period from June 21 to June 22, the largest annual gain on record since they've been taking numbers. $300 billion of consumer debt. That's a lot. So that's keeping the wealth disparity further and further and further apart. What we're trying to do is close that gap so that way that 300 billion gets less and less and less. We should never hit that record ever again. And also, as you can see right below that, that's a picture of the homeless and the poverty that's shown in Los Angeles as of this year. Those are 10 cities, you know, that's where the disparity comes from. This is why we're trying to get this, close that gap and improve things for all of us. All right, so on this one, there's no more comic relief, no more comics or anything. We got a chance to see the 300 billion in the consumer debt over the last year. We also had a chance to see the poverty that's going on in LA. What this chart is showing you is that the home affordability rates and why some of that poverty is actually out there and why it's growing in regards to that. As you can see, the home prices in 2020 was just a little bit less than 250,000. Now it's gone up to over 388 on an average as of 2021. That's about a 60% increase for the same type of home. The bad and scary thing about that is that our incomes have not increased whatsoever to cover that difference and that gap. Thus, the disparity becoming more and further apart. Along with our income being low, expenses continue to rise, home affordability is going up, rents are going up, houses are going up. So it's kind of where we at? What are we trying to do? Why is our money not going the same as it was last year? I know you guys always heard your parents tell you about bread costing 50 cents, gas was less than $1. We're living in that time of true extremes. When I was younger, gas was around $1.50, $1.80 on the high side. Now we're looking at $3 to $4, $5, depending on what part of the country you guys are in. So financial education, financial awareness, the important fact of us becoming more aware of what's going on and how we can improve our own personal situations is becoming more and more prevalent, or we're going to continue to see this gap get further and further apart. Our first topic, and probably most important before we get anywhere else, is where are we currently at with our finances and our budget? How are we living? Are we paycheck to paycheck? Are we just making it month to month? Are we scraping by using the credit cards, being a contributor of that 300 billion? That's the consumer debt that's out there as of a couple months ago. Or are we doing more in our savings, not enough investing, vice versa? Where you guys are currently at, and that's where we need to be at, is figuring out our current baseline. And that's basically getting all your income resources together so you can get that totaled up. The income resources need to be consistent, counted on each and every month without a doubt, knowing that it's coming in. Obviously, you may have some fluctuations depending on if you're commission based and things like that. However, we need to have those income resources consistently that we're getting in so that way we can account for that. And then we need to gather up all of our debts, bills, obligations, responsibilities that we have to take care of minimally on a month to month basis. So that way we can have our pluses and minuses together. We got to have what's coming in and we got to know what's going out. Once we get these calculated, we basically got a personal profit and loss statement. So that way we can actually now see, are we in the red, we in the black, or if you want to say green, whatever the case may be. We got to know if we're plussing, meaning that we have extra cash flow per month. Are we in the minus and in the red and behind each and every month, scraping by, and that's the paycheck to paycheck, or barely getting paycheck to the next paycheck. And this can be very enlightening in regards to where you're at, and where you're trying to go are extremely scary in the fact that, oh my God, what have I been doing? Once we have that created profit and loss statement, get that baseline and that starting point, and as I mentioned, it can be extremely enlightening or extremely scary. This is where we find out that with all our pluses and minuses that we got, how lopsided are we? If we are we overextended? Are we saving too much, not investing enough, and so on? However, you can also realize where you're personally at in regards to your management and what you do for your budget by looking at what you have going out. Are you shopping too much? Going to restaurants too much, have a coffee addiction with Starbucks, Chick-fil-A, or all these other Chipotle places that we can spend our money. Are we not spending enough on grocery because those are going up and we're going out to eat? And can we do something different about that as well? So once that baseline is established, we can start figuring out what our personal management level is in regards to what are we doing on a day to day, what are we doing week to week, are we spending too much on TV subscriptions, Netflix, and things like that, and find a way to minimize what's going out and get more to come in, so that way we can start putting more in our piggy banks. Because at the same time, once you have that baseline set up, now you got to figure out, all right, am I making enough so I can get by, or am I not making enough? And then we start figuring out where things really need to be at, and hopefully start understanding that we need to make a change on what we're doing personally in order for us to really get where we're going, because we can't blame everybody else for our own personal situations. We have to take accountability for our own and figure out what our goals are, what our family needs, and where we want to go. So this is where setting goals, making a plan, taking actions is going to be extremely important. And this comes from knowing where we're currently at with our current finances, getting some clear and defined goals, so that way we can figure out where we need to go to so we can improve and bridge that gap even further. So let's start doing that as we start thinking and hearing, is setting the goals, making a plan, and most importantly, taking actions. Budget, what's coming in, what's going out. Now we need to figure out exactly where we're at with our credit. Credit is one of the biggest things that helps our finances or hurts our finances because of what we do know, don't know, and all the misconceptions, misinformation that's actually out there about credit. Credit is one of those things that it's so much that goes into it. There's not really one set rule, one set number on some of these answers that's there. So what I'm going to do with this is teach you guys what the game is, so that way you can understand how to play it. And that way, once you know the rules, you can stay within those rules and continue to improve from there. So getting a baseline is where you're going to need it to be on your credit report as well too. So if you go to annualcreditreport.com, you're able to get your free credit report per year from Equifax, TransUnion, and Experian. So that way you can get a baseline of what's all on your credit, understand what you currently got going on, and figure out what you may need to do to improve it or to better it. And obviously paying bills on time is one of the biggest things that we all know about. Yeah, pay the bills on time, but there's a lot more than that. And a lot more goes towards building that up. But first and foremost, paying your bills is the largest factor in regards to our credit report and our score, which is 35%. Then you go to the next factor, which is amounts owed or the debts on our credit, which is also called credit utilization, which is 30%. The length of credit history in regards to how long our accounts have been on there is 15%. New credit and inquiries is 10%. And also types of credit, which is also known as mix of credit, is 10%. So real quick breakdown, payment history speaks for itself. Pay them on time, pay them every month, don't be late. Amounts owed or credit utilization is one of those catch-22s to where if you have $1,000 limit, you want to keep your balance underneath $350, which is 35% usage on that card. Keep it under 30% is $300, which is going to give you some better point value on a month-to-month basis. But if you keep it under 10% on that credit card, keeping $1,000 balance, or excuse me, $1,000 limit, and you have a balance of less than $100, That's less than 10%. That's considered excellent in regards to being able to manage your credit and being responsible with it. Now, obviously, we will use that card as we need to, and some people use it, pay it off each and every month. That's also a catch 22 in regards to if you pay it off every month, you're not getting any point value for it because there's nothing on there to report. So I always just want to let you guys know if you're in a point to where you need to build your credit up, you want to keep a small balance on there, 50 to 100 bucks. And that way you can show that you have a small balance, you're getting maximum point value, but you can still use the rest of the card as you need to if you're paying it off. And that's the game. It's the game. It really is. However, if you're trying to get to where you need to go, knowing the game, knowing the rules will help you out. Credit history, that's going to be the length of credit. They want to have 7 years of good accounts, good history for that to be considered established. Anything less than that is obviously newer credit. First year to two is going to be brand new credit, where it's going to hurt you a little bit more in the beginning because you have brand new debt that's on there and you haven't built up enough time for it to really show you your responsibility in regards to managing that. New credit and inquiries, your first 12 months will stay on there. After that, it doesn't affect your point value. However, those inquiries can stay on there well over 2 years. Some can be up there for 4 years, depending on the companies. The mix of credit, you want to make sure that you guys are having 3 to 5 different revolving cards. Could be credit cards, store cards, gas cards, even a HELOC or home equity line of credit, along with 2 to 3 different installment loans, which could be a mixture of mortgages, car loan, student loans are the biggest ones that can be on there, but it could be any type of installment loan that's on there versus a revolving debt. So just understanding that will help you out in regards to getting that credit where you need it to be at. All right. So now that we got a basic understanding of how credit scores are factored in, what is contributed into it, and how the score game is played, we now can actually grow and enhance our financial awareness even further, for the simple fact that we know how to play the game, what they're looking for, and we know how to manage our own debts, so that way we can continue to get maximum point value, continue to keep it good, continue to keep things moving in the right direction, up and up and up. Because credit scores do start between 3 and 850. Depending on the credit reporting agency, they do each have their own internal algorithm in regards to that. But those 5 factors are the same amongst all 3 of them: Equifax, TransUnion, and Experian. So with that being said, knowing how to play the game will work for us. When you're on the mortgage side, you start going through this process of buying a home or refinancing, then we do pull something that's called a tri-merge credit report. What that is one credit report with Equifax, TransUnion, and Experian all merged onto one report. So that way we can see everything just with one pool. And the median score is used between all 3 of them. So not an average, just the one in the middle. So if you got 3 scores, we just take the one in the middle. If you only got 2 scores, we take the lower of the 2. If you have 1 score, some companies will take 1, but you want to start doing something so that way you can have all 3 bureaus being reported with that information that you have on that one report that is giving you a score. So when you do pull your credit, one of the misnomers is that you don't want to have too many being done for shopping reasons, right? But when you're doing a mortgage or even a car loan, they do expect you to have 2 to 3 different lender pools on there, for the simple fact that it's a very large purchase, so they want to make sure that you at least have a chance to look at more than one place. You don't have to be stuck with one, although the more you do have will be a hard inquiry each and every time, which goes into the inquiry that we mentioned in regards to the 10% affecting your credit scores. So shopping too much can be a hurt on your score, and if shopping too little will not give you enough options to make sure that you're getting the best programs available for you. So, but you have a small 14-day window, 10 to 14-day window, where you want to make sure that you are, if you're going to do it in that same time frame. All right. So when you do get that, most lenders do have programs start around a 500 medium credit score on certain loan programs that will be able to help you out. So that 3 to 850, starting at 500, we can have some options available for you. The better the score, better the options, obviously. The lower the score, most likely you need to come up with more down payment and things like that. But we'll talk on those on individual situations. And that's when you actually want to locate and find you a licensed mortgage loan originator so that way you can figure out what your options are. And that is someone like myself. And that's why I'm doing this, to provide more information so that way we can all be in a better spot when we do get ready to move forward. All right, so now that we got our finances and budget together, we got our credit understood, let's go into the cost of home ownership, right? So when we dream of our home, we're dreaming of the dream. We want the nice rooms, the big bathrooms, the high ceilings, the pool, the big yard, and everything else that makes it a dream home, right? So when you dream of that, you're not talking and thinking about the cost expenses that go along with owning the dream home that we want, right? However, it is important to know, and it is something that we need to make sure that we have an understanding of. There's two big sets of costs that I want to go over in a broad category, which is the upfront cost and home purchase. And then you also have the second, which is the ongoing maintenance cost to keeping the home and your dream home up to par and where it should be. So these two categories could combine will give us the true cost of home ownership, which everyone should be thinking of once you start getting to the thought of, I want to buy a house. And so once you're ready to buy that home, that dream house that you guys been thinking about, the first set of costs is the upfront cost and getting into the home itself, which is included into the financing, the down payment, appraisal, home inspection, credit reports, loan program costs if required, which there are many different programs available, loan origination costs, underwriting and processing to get the loan to the finish line. Then you also have things such as your local taxes, transaction taxes, county taxes, recording fees, title work to search the property out to make sure that there's no encumbrances or liens on there, the insurance that's needed on the home, property taxes that need to be paid out, homeowner insurance that you need to get up front, the home warranty should you want one, which is optional, discount points should you want to buy down your rate, and other similar type related costs that will be all part of that initial setup of getting you into the home. Every program, every scenario, every situation is different. Every county has different fees and charges and costs. So all those need to be looked at on an individual basis based upon the home, where you're at, and looked at. The second is going to be the ongoing maintenance costs for once you do get into the house and you've moved in. So might be showing my age here, but have you guys seen the old school movie, The Money Pit, which is with Tom Hanks, and I can't remember his co-star actor, but it's one of the best, worst examples possible of exactly buying a house. I mean, if you haven't seen it, please pull it up on YouTube or go rent it or Netflix or anything else and try and find this movie. It is hilarious, but it also gives you the true factor of a fixer-upper and what you can expect when you get in there. But hopefully we don't get ourselves in those situations to where that is what we run into. So if it is, then you probably bit off way more than you could chew. However, the broad stroke of getting the ongoing maintenance cost would be your monthly payment of the house, which is your PITI payment. That's an acronym for principal, interest, taxes, and insurance. So you got everything combined. And if you have any kind of mortgage insurance, such as mortgage insurance premiums, that would be also part of that PITI. You also have homeowners associations, which is becoming more greater in most areas now, that you need to be aware of, whether that's a monthly, quarterly, or even semi-yearly, or just annually payments. You have your normal water, lights, gas, trash, sewer. So once you get out of a rental home where everything's combined into usually just your house payment and maybe you got your gas or lights, you now have water, sewer, trash that you need to add into that as well. Now, don't forget your food. You got to eat. You got to take care of your property. If you're in an HOA, you definitely need to make sure you take care of your property. Otherwise, you'll get fines and fees and hit up in regards to that. Are you going to do it yourself? You're going to hire a service. You got to clean the house. You're going to do it yourself. You're going to hire a service. Home repairs, are you handy enough to handle all of that stuff? You got to furnish the house. You obviously don't want to get a nice home and you can't sit on anything besides the floor because you didn't have enough money to buy a sofa or a couch. However, ain't nothing wrong with no air mattresses and things like that if you need it for the time being. However, you want to actually furnish the house. So you got to take in those costs as well too. Home entertainment, are you going to have TVs in all your rooms? Subscriptions is going to, if you're bringing all that stuff over, then you should be able to account for those same costs from your previous location as well too. Hopefully, as you see some of these costs that's involved, you can do some pre-work and maybe buy some of these things that you want to take with you versus starting from scratch when you do get into your new home. So with that, those two costs need to be truly thought about as well too. So your upfront costs getting into the home, then your ongoing maintenance costs for once you do get in there and how to maintain that property moving forward. All right, so now that we've assessed the costs up front and maintenance costs estimated that we'll need throughout the time of in the home, now let's look at the mortgage side of things here, mortgage financing 101. I'm trying to give you guys a quick breakdown. So much that goes into this, but I'm going to try and do my best here in the short amount of time that I have with you today. So a lot of people look at mortgages and they only think about rate and the cost of it, right? However, to me, it's more value versus benefits. However, all four of them need to be really considered: rate, cost, the value you're getting, and the benefits that you get at the end of the day for going through the entire process. The benefits at the end of the day to me and the value that you get from this sometimes arduous process is the most important because that's what you're going to be living in. That's what you're going to be happy to see. That's what you're going to be living for in regards to this is our home, right? So with that being said, this is not a do-it-yourself process. Like you can't just go online, apply, pick something out, and keep it moving. You have to have some people involved, professionals in regards to that, licensed to make sure that you're doing it the right way, which is having a financer, mortgage loan originator, which would be someone like myself. I want to give you a breakdown on that. And then you also want to have, different team players that'll come about as I'll go through that here shortly too. But as your mortgage loan originator, there's two different types that you can have. You have one that'll work with the direct lender, which is going to work with one company. Usually, your big banks, Wells Fargo, Bank of America, your credit unions, or any other actual bank established location. They'll have one company and just their options within them, which is sometimes just a few that they may have. You can also work with the broker, a mortgage broker, which is someone like myself, where I work with more than just one lender, and I have each one of those lenders loan options available to offer, more tools in the tool belt. So that way, if you can't fit into the box over here, I can get you into a box over here. For every company has different regulations that they do have. All of them do follow the main national guidelines and agency rules that's there. However, each company creates their own individual overlays. So that's their own internal additional guidelines on top of the national rules we all have to follow. And that's where you start getting a breakdown of, well, you went to that company, you couldn't get approved, but you go to this company and you can, or vice versa, right? So once you understand that, then you can have an understanding of, well, let's make sure we get the best options available. Now, the good thing about working with a direct lender is that they are a direct lender. They may have some good stuff directly because you're maybe are already a member of the bank, so they may have some options in regards to that. Credit unions, farming institutions and things like that, they may have some good things because they're locally established. Now, the good thing about mortgage brokers is that not only do we have just that one lender, we got quite a few. So depending on the company that you do have, mine particularly with Baird Financial, we have over 50 something odd different lenders, meaning that we have options in residential, commercial, and all the other programs that's available. And if you don't fit into one of these other ones may work for you too. So we only need to look at one credit report as we do this. We don't have to pull one for each and every company we look at for you. Vice versa for auto loans, it's not the same. Every time they go look at a different financing company for you, they will pull your credit report And that's why when you are shopping for a car, you generally see 10 to 15 different lenders because they're shooting it out there, your credit, and just hoping one of them comes back with the response. For us, it's a little different because we know that having your credit pulled at multiple places will start adding up and start hurting you. So we use one credit report, and on the broker side, we can talk things out before we send your actual loan to them, making sure that you do qualify, you fit in those parameters, and we can present you those options up front. All right, so there are two types of residential loans that are out there. You have a QM, which is qualified mortgage, which is going to consist of your conventional loans, which is your Fannie Mae, your Freddie Mac. Breakdown between the two. They both have multiple programs between the two of them. You also have your government loans, which is the ones that most people do hear about, the FHA, Federal Housing Administration. You have the VA, Veterans Administration. You also have the USDA, U.S. Department of Agriculture, for the ones that are a little bit further out of the metropolitan areas. You also have jumbo loans for the ones that are above and beyond the conventional loan limit. And you also have the second type, which is non-QM, non-qualified mortgage loans, which will give you options in regards to now bank statements, DSCR, debt servicing ratio, coverage ratio loans, asset utilization loans. So if you don't have monthly income, but you got, 10 million in the bank, we can just use your bank funds to get you qualified versus your traditional route as well. So that's one of the good things about having multiple options, different tools in your tool belt, is being able to help and serve more than just your square box loans. And that's why I like being on the broker side of things versus direct lender, because I did do that as well. However, the broker side provides more options, more solutions to help people get to where they need to be at. Now, there are certain types of loans and programs that are out there. Once you meet those personal financial qualifications, now it comes down to the type of property that you're going to be actually financing. So you also have multiple things on the residential side. You have the single family, you have 2 to 4 units or 1 to 4 units. If you have a fourplex, you can do manufactured, the single or double wide, and that also goes if it's on permanent foundation or not. You have condos, which can be warrantable or not. Your primary home, your second home, or if you're doing it for an investment. So you do have the two types of things of purchase or refinance, rate and term, or cash out. So all of that right there is just a bunch of options that I mentioned, that each one comes in different factors on different loan programs. And each company will have different factors that go along with the type of property, your residency of it, if it's investment or if you're living there. So all of those things are elements of a loan that create risk factors. Each time you level and put something on there, such as, all right, well, you're not doing just a single family, you're doing a 2 unit, level of risk. If your credit score is not 850, a little bit lower, level of risk. If you're doing a big down payment, little bit of risk. So all of those factors gets added into the loan to come up with that total rate and cost of that loan. So that's where we come in at, to try and look at your options to make sure that when we present those to you, we've already looked at the best scenario that gives you the mixture of rate, cost, value, and benefit per your personal situation, personal goals, and what we're trying to do for you as the loan, right? So all of those factors come into play. Most importantly for you to know is we're looking at your income, your credit, your assets for purchasing, because you need your assets for the down payment, closing costs, and everything to show that you're ready for this home. If you're looking at refinancing, we'll be looking at your credit, we're looking at your income, and we're looking at the equity that's already in the home. So you may not have a dime in the bank, but you have equity in your home, and that is your savings. And that's what you pull your money out on to use towards home improvements, bill consolidation, taking trips, college funds, or even pulling that money out and putting it into other investments to make that money make money for you, which is the smartest way to do it, and put yourself in a much better spot using what you've already created in your equity from owning the home already. So With that being said, there is no loan that fits everyone. There's no one size fits all. Every loan is customized for your individual situation. Of course, we all deal with the macroeconomics of the rate, the home pricing, and obviously depending on where you're at, those are things a little bit out of our individual control. So that's why each loan, each scenario should be based upon what your personal situation is, what your personal goals are, and what you personally qualify for, which is the most important, what you qualify for, not your neighbor, not your friends, not your cousin, not your dad, mom, whatever the case may be. It's what you qualify for and what your benefit is, because it will be based on your situation, not anyone else's. So before you go into any loan process, the most important thing is knowing your goals, so that way we can make sure that we have that as our solution focus, and that way we can accomplish the best thing to get you to where you're trying to go, with all the options available will be customized based upon your game plan as much as they possibly can be. So knowing loan options, having the guidelines is extremely important, and that's where the mortgage professional comes in at, to help you create the game plan to get you where you want to be at. And the better they are at understanding the loan options that they have, the guidelines to tie everything together for you will help you customize that option to give you the best bang for your buck, that encompasses the best rate, the lowest cost, the most value, and the most benefits that you can get out of any loan scenario, and make this process better for you at the end of the day. Know you guys heard this one before. Teamwork makes the dream work, baby. And it's no more true in this industry. Having separate roles and having a team in place will ease your burden, lessen your stress, and put you in the best spot possible. If you hear someone that says, "Hey, I'm a realtor, I'm a broker, no appraisers, and I can do this, this, and this, and this," the jack of all trades, specialist of none. You don't want that in this industry, because it's too much to know. I've been doing this since 2001, and I'm learning something new still every day on the mortgage side of things, because there's new programs, new guidelines, new information that's out there. If I was trying to be a realtor at the same time, I'll never be able to stay on top of this part of it. And this part of it is what I like, because without the financing, without the money, nothing you do with any other person on the team matters, because you can't get approved. You can't end the deal and close on that home. So you'll be wasting everyone else's time. Two major conduits that you do want to make sure you have in this process is a real estate agent and a mortgage professional. Mortgage professional comes in first in regards to financing, because without the financing, the realtor will not be able to get you to a house. They can show you everything all day, all long. You can like anything and everything. You can make offers until you turn blue in the face. However, if you have no financing in place, you're not approved, you haven't took care of that part of it, you're shooting in the dark. And then that's when the process becomes a little bit more stressful for you, for the simple fact that you didn't do that part first. You may not qualify for that home purchase. You may not have enough funds. Your monthly payment may be too high. All of those factors now become, oh man, you done put money down, earnest money, and all of that you may actually lose because you didn't have financing in place. And that would be falling on you, not the realtor, not the mortgage professional, but you, because you didn't have that taken care of, which is most important. Get your finances in place. Get your pre-approval, not a pre-qualification. Get a pre-approval, knowing that your income, your credit, your assets has already been looked at, which is a big difference between a pre-qualification. A pre-qualification will simply give you, they basically looked at it, but it did not go through a pre-underwriting process to make sure that you would be approved for what you're looking for. The pre-approval part comes in extremely important, for the fact that all you need to do now is find the home that fits into these numbers. You're approved for 350. You go look for a home that's for 350, because you've already got your income, your credit, and your assets reviewed. Anything under 350 or at, you've already approved. Your headache is gone. You've already gotten through the hoops. You've already jumped through the process. You've already taken care of everything. So as they accept your offer, you guys are good to go. All right. And that's what's important, because when the realtors are running you guys around, showing you this different house and that house and this house, they want to show you homes that you will qualify for, that you can make an offer on, and once it's accepted, you can close on it, and you don't lose any earnest money or any sleep before, because you don't have to worry about, will I be approved? You're already approved, which is why it's more important to be pre-approved versus pre-qualified. Pre-qualified, we're just looking at the numbers. It looks like it's good, but it has not been reviewed by the underwriter. And that's what you want to have. The underwriter looking at everything here for you. Because once you get into the house or get the house you want, that's when we can also come in and show you some other roles that people can play for you. And we have contacts for, credit repair should you need it. Home inspector, because you're going to need one of those. You got to get your home inspected, even though it's an option. Definitely recommend it. If you need some updates done on a house before you can buy it, after you buy it, those are programs available, and also contacts available for you as well too. So having the realtor, having a mortgage professional, we can direct you to where it's needed depending on whatever the scenario is for you. And that's where having those two conduits come into play is most important for you. Knowing who to call, when to call them, why to call them, and if you have a trusted recommendation for them, will make your life a lot easier. So once again, get pre-approved based upon your income, your credit, and your assets. So that way, when you go work with your realtor, they know what you're approved for, and they can put you in the best track to find a home that fits your qualifications. All right, guys. So I appreciate you guys' time sticking with me here. As I mentioned, home finances is one of the most understood type of subjects that's out there. There's so much information. I've already taken over 40, almost 45 minutes of your time, and I haven't even touched on programs and got into more details in regards to that. So this is also one of the major reasons why wealth disparity is continuing to increase, because of the knowledge that's needed, the misunderstanding that's out there, and so many different opinions on things without giving you fact to help you guys out. It's a lot, and that's why professionals are licensed to make sure that we provide you with the best information, because as a mortgage broker, I do have a fiduciary responsibility to make sure I put you in the best spot possible. If not, then I'm putting myself in the worst spot possible, because I don't want to go to jail and I want to keep my money for my family. So with that being said, we want to make sure we provide the best service to you, which is why, again, this workshop is important for me to give to you guys, to make sure that it's a good high level overview for you, to make sure that we have a basic understanding what we're getting ourselves into, what we're looking into, and making sure that as we're being more focused on those financial goals, that we got resources available to us. So with that being said, again, I appreciate you guys' time. Thank you for taking the time to spend it with me. If you have any questions or anything like that, then please just reach out to me. That's what I'm here to do. So again, we want to grow our financial awareness, increase our independence, and build generational wealth for us and our families. So dream big, set your goals, narrow your focus, and take your first step, take an action, and stay consistent with moving forward. All right, guys, here's the contact information. Should you guys need anything from me, please reach out. I'm here to help. If you have any questions or anything along those lines, please let me know. Anything about today's topic, any customized situations for yourself, anything that you're not aware of or want to find out more about, please reach out to me. I'm here to help you guys out. But as you guys can see with this chart here, to end with, time and wealth, you need them both. But it takes time to build that wealth. There is no overnight successes that's out there. So continue to set your goals, make a plan, and take action to move forward and take advantage of everything that this world does have to offer, because it's so much abundance that's out there. We're not in competition with each other. We're in competition with ourselves. Do the best you guys possibly can. Strive for excellence. And I appreciate your time.